Welcome back, everyone. Now, this week's explainer isn't just your standard run-through of economic data. We are talking about geopolitics and how suddenly shifting tectonic plates on the world stage can completely upend traditional financial charts. Over the weekend, tensions between the United States and Iran escalated once again, with Tehran announcing the closure of the Strait of Hormuz. And honestly, whether that disruption ends up being a temporary blip or a prolonged standoff is exactly what could become the absolute biggest driver of global markets this week. So right out of the gate, we've got a massive question to answer. Instead of trying to guess which scheduled economic report matters the most, the real question, the one literally every trader and investor needs to be asking right now, is this. Which catalyst is actually going to dominate market sentiment? Is it going to be the hard, scheduled economic data, or is it breaking geopolitical risk? Okay, let's jump straight into Section 1, the big picture, dueling narratives. Right now, traders are caught in a pretty intense trap. We've basically got two completely different storylines fighting for dominance. On one side, you have the standard economic story. You know the drill. We're talking inflation metrics, central bank policy, and interest rates. It's the classic playbook. But on the exact opposite side, we have geopolitical risk. We're talking sudden shocks to the global oil supply, disrupted shipping routes, and those sudden, panic-driven safe haven flows. Here's the deal. If geopolitical headlines from the Strait of Hormuz keep dominating the news cycle, markets might just completely ignore the scheduled economic releases. Even if it's only temporary, that is a fundamental shift in gravity, and you really need to understand that before navigating this week's trading environment. Moving right along to Section 2, the economic calendar, scheduled volatility. Even with those geopolitical tensions flaring up, the scheduled calendar still poses a massive baseline risk. Tuesday is the undisputed heavyweight day of the week. That is when we get the latest US CPI report, which, as we all know, is one of the Fed's most closely watched inflation indicators. Then, right on its heels on Wednesday, attention pivots to the Producer Price Index, or PPI. That gives us a vital read on inflation pressures from the producer and wholesale side. Put them together, and these two data points are going to help investors figure out if inflation is finally cooling down or if it's revving back up all over again. And this brings us to the standard fundamental reaction we'd normally expect. If Tuesday's CPI comes in hotter than expected, the dominoes usually fall pretty quickly. Markets will instantly reduce their expectations for future rate cuts. That drop in rate cut bets normally pushes Treasury yields up and as a result supports the US dollar. That's the traditional economic machine working exactly as intended. But that brings us to Section 3, shifting market psychology, the inflation source. This is where things get incredibly interesting because that standard economic machine we just talked about, it might completely break down this week. Think about this dangerous new chain reaction. Step 1, we have real supply concerns in the Strait of Hormuz. Step 2, that leads directly to rising oil prices. And Step 3, we get inflation without economic growth. That is a highly toxic scenario known as stagflation. Normally, higher inflation is a bullish signal for the dollar, right? Because it implies a hot economy and higher interest rates. But this week, inflation might not be coming from strong consumer demand at all. It could be imported entirely through higher oil prices triggered by a supply shock. If oil keeps climbing because of what's happening in the Strait of Hormuz, markets are going to start sweating over stagflation. And let me tell you, that is an absolute nightmare of an environment for central banks to navigate. So how in the world do we position for that kind of nightmare scenario? That brings us to Section 4, the asset watch list, defensive positioning. First on the radar, crude oil. It is literally ground zero for this entire narrative. If crude continues to break out to the upside, those inflation expectations are almost certainly going to surge right alongside it. It's the primary catalyst you absolutely have to watch. Number 2 is the US dollar index. Honestly, regardless of what the CPI data prints, if geopolitical uncertainty keeps ramping up, the dollar is uniquely positioned to catch some very aggressive safe haven demand. When the world gets nervous, cash rushes to the greenback for safety. It's as simple as that. Asset number 3 is gold, and this one paints a pretty complex picture. Gold usually thrives on exactly this kind of geopolitical fear. But you've got to watch the tension here. If Treasury yields start rising aggressively alongside the dollar, maybe because of a hot CPI print, gold's upside could get severely capped. It's a massive tug of war right now between geopolitical fear pushing it up and rising yields trying to pull it down. Rounding out the watch list is the Japanese yen. During periods of severe geopolitical stress and market panic, the yen acts as a primary target for defensive, risk-off flows, and it often outperforms right alongside gold. If market sentiment takes a sudden dive, keep a very close eye on the yen.
Finally, let's look at the broader fallout in Section 5, Major Market Expectations, Broad Vulnerability. The base case for this week? Volatility is going to remain absolutely elevated. But let's look at the specific vulnerabilities across the board. First up, the euro. The euro could be in for a real struggle if risk-off sentiment strengthens and capital decides to flee Europe in favor of defensive assets like the dollar or the yen. And then, consider U.S. equities. This is vital to grasp. Right now, the biggest risk to the stock market isn't corporate earnings, it is energy. A sustained spike in oil prices out of the Middle East would drastically inflate inflation fears and could put immense, crushing pressure on stock valuations. That could completely override whatever earnings reports happen to be crossing the wire.
Which brings us to our final overarching thought for the week. Expectations may change faster than the numbers themselves. This is one of those rare weeks where sudden, unexpected headlines could move the market way faster than the scheduled economic calendar ever could. So don't just stare at the CPI and PPI data. Watch how the market actually reacts to that data. And more importantly, watch how markets respond to every single geopolitical headline flashing across the screen. The big question is, are you prepared to trade the headline rather than just the spreadsheet? Keep that in mind as you navigate the turbulent days ahead. Thanks so much for joining me, and I'll see you in the next explainer.